What are the penalties for 529 Plan Non-qualified withdrawals? Imagine saving for your child's college and suddenly needing to take out money for something else. You might wonder what happens if you use your 529 Plan funds for non-education expenses. Well, let's break it down. When you withdraw money from a 529 plan and don't use it for qualified education costs, the IRS considers that a non-qualified withdrawal. The main penalty is a 10% federal tax on the earnings part of the withdrawal. This means only the growth your account has made, like interest, dividends, or capital gains, is taxed. The original contributions are not taxed because they were made with after-tax dollars. Besides the 10% penalty, the earnings are also subject to regular federal income tax. Some states might add their own taxes or penalties too. For example, California adds a 2.5% state penalty, and some states requiring you to pay back any state tax deductions you received when you put money into the plan. Qualified education expenses include tuition, fees, books, supplies, and required equipment. Room and board are also qualified if the student is enrolled at least half-time. But expenses like transportation, insurance, sports fees, parking tickets, or food not included in housing are not qualified. Using plan funds for these will trigger penalties. There are exceptions, though. If the beneficiary dies or becomes disabled, or if you receive scholarships that cover some costs, you might avoid the 10% penalty. For parents in Generation X, who often juggle saving for college and retirement, understanding these rules is key. Keeping track of receipts and timing withdrawals to match when expenses are paid can help avoid penalties. For example, if tuition is paid in 2025, the withdrawal should happen in 2025 too. If non-qualified withdrawals are unavoidable, consider having the funds sent directly to the beneficiary. This way, they might use education tax credits to offset some taxes. To sum up, penalties for non-qualified 529 plan withdrawals include a 10% federal tax on earnings, regular income tax on those earnings, possible state taxes or penalties, and repayment of any state tax benefits received. Careful planning, knowing what counts as qualified expenses, and timing your withdrawals properly can help you avoid these costs. For families balancing multiple financial goals, understanding these rules helps protect your savings and makes sure your money works best for future generations.